Today we have, and I believe, some of the best minds in investment in Jamaica. We will have a panel discussion with them. Topic being investing in 2022 and beyond. What are best investment vehicles in the capital market? With me, we have Mr. Sekou Crawford, Acting Head of Investment Banking at NCB Capital Markets. I'll ask him to join me on the platform. Also have Mr. Ryan Strawn, Vice President, Investor Relations at GK Capital Management Limited. I'll invite him also to join me on the platform. We have online Ms. Sarah Cummins, Vice President, Capital Markets at Scotia Bank. And joining us soon is Mr. Peter Thompson, Group Manager, Client Investment, JMB Group, and Mr. Richard Williams, Assistant Vice President, Investment Strategy and Portfolio Advisory, Barita Investments Limited. Richard is here. Welcome, Richard. So we have 4 of the panelists, and I believe this segment of the program should prove to be a very interesting one. Let me once again, for the sake of those viewing online, indicate who they are. We have Richard Williams, that's to my way right, then Ryan Strawn, and then Mr. Sekou Crawford, and online Sarah Cummins. The first question, which I will pose to all the participants here, and they will answer according when I indicate. What are the best investment opportunities available to individuals and small and medium enterprises for 2022? I'll start with you, Richard. What are the best investment opportunities available to individuals and small, medium enterprises?
All right, thank you, Nigel. Good morning, everyone here and those online. The first point of departure for individuals, I would say, is local equities. We remain constructive on the outlook for Jamaican businesses, particularly those listed on the and so we are pretty gung-ho about the future ahead for these companies. So that's an outlet for retail investors. And in terms of numbers, we can even look at the 10-year average PE on the main market. It's about 13 times. Currently, the average PE is about 10 to 11 times now. So it really represents a steal for local individual investors. For small businesses, it's a little bit more nuanced because cash flows are important for them at this point. And so on the capital market side, such as Ryan and Sekou, I'm sure will speak more to this, but they are looking for opportunities in those areas through private credit funds, origination of assets here to fund these businesses. So that's an area that small businesses can look towards now, because I think they would be prioritizing operating cash flows, and those pools of capital are available to tap into. Barita as well, I should say.
Thank you very much. I go to the lady online, Sarah Cummins. Can you comment on the question? What are the best investment opportunities available to individuals and small businesses?
Hi, good morning. Thank you. Can you all hear me?
Yes, we are hearing you.
Okay, great. So with regards to the question on the retail or individual side, what I would say is that the best investment opportunities would really be dependent on the investor's risk profile and appetite. So at Scotia Investments, particularly when you're looking to start investing, a suitability discussion is had with you in terms of understanding what your risk appetite is. And from there are opportunities for investments in certain funds. So Scotia Investments has quite a wide variety of funds that see you being able to take advantage of returns to various assets and assets of different risk classes. So I would agree with what Richardo said, and certainly what we're seeing on the equity space is that there is potential for growth. So again, in Scotia Investments, when we work with our retail clients, we would share, a list of equities that we believe have potential for growth in a 12-month outlook. Obviously, the evolution of the pandemic and how we reopen will dictate a lot of those returns. But certainly we are seeing, or we expect to see in 2022, more activity in the equity space. More of our main market listings benefiting from that reopening. On the corporate side, or for small businesses, what I would say is that we have at Scotia a separate sales manager for corporate clients, right? And again, we take a portfolio management approach because, like Richardo said, what we find with small businesses, our corporate clients, they want to be able to access that liquidity for their operations. So we tend to tailor opportunities that maybe give them income or give them that flexibility to go in and out of the investment, right? They may have a shorter time horizon. And, certainly in our space, we're seeing a lot of the corporates being interested in more, commercial paper, short-term corporate bonds, because this gives them the income. And with the advent of more of these private placements being listed, being rated, it's becoming an asset class that is deemed to be more liquid and tradable. And so for that, we're seeing where corporates are having an interest in looking at these types of papers.
Wonderful. Thank you very much. Ryan, your time to.
Sure. Thank you, Nigel. Morning, everyone. What we are seeing generally is an environment that has provided a series of discounts. Asset prices that are listed and even unlisted are discounts. So that's the frame that we approach our whole client engagement from. You look at the local market, as Richard would have spoken to, we see discounts there. The overseas market, as turbulent as it is, we see discounts there as well. And we even see discounts in the fixed income space, which is spoken to by the increase in rates, as we would have seen by BOJ rates, and there's talk of the federal fund rates going up. So, our approach is to, of course, understand the client's needs and steer them accordingly. And I think that has been fleshed out by my colleagues on the panel. With regard to small businesses, though, one of the things that we have said is, listen, you can invest in external assets, meaning, other stocks or whatever, or you can take advantage of the time and invest in your internal assets, meaning, is it the opportunity to try and buy a competitor that's struggling and we can assist you with that? Is it to be looking to list, or is it time to get cheaper debt? Well, prior to, I guess 3 months ago, is that the route one should take? So we don't just look at it in terms of deploying the small businesses capital, but also to see how we can generate capital for them, or opportunities, or take advantage of the discounts. And that really seems to be the the great opportunity now, because there seems to be some resetting in the middle, between the top and the base of the markets. The SME space bears great promise, and we've kind of honed in on that. So that'll be my contribution.
Thank you very much, Mr. Crawford. Your time.
Hi, thank you, Nigel. You saved the best for that. Yes, I will try to keep up with my peers. For me, if I was an individual investor, I would ask myself, what is happening at a macroeconomic level, and how can I benefit from that? So,
Recording in progress.
yeah. So, you hear buzzwords every day in the news. You hear about rising interest rate environment. You hear about inflation. So if I'm an investor, I'm going to ask myself, what sectors and what firms operating in those sectors that I can trade publicly will benefit from what is happening in the macroeconomic environment. So for example, with rising interest rates, who may benefit from that and who will suffer from that? You can divide that into the various sectors. There's the financial stocks that are listed on the stock exchange. For those that are funded by deposits mainly, you expect that their margins will widen from a borrowing and lending perspective. And they're also experts in positioning their portfolios to navigate the times as asset prices that are on their balance sheet are going to be volatile. I'd also ask myself, okay, those manufacturers who sell goods, did they use the pandemic to make their businesses more efficient? Did they use the opportunity, given the slowdown, to reinvest in things that were outdated and recapitalize their machinery? So to the extent that they can, they'll have to pass on some of the effects of inflation onto their consumers. To the extent that they can keep their costs, not rise as fast, they may also benefit from what's happening from a macroeconomic perspective. The small businesses now, Ryan touched on it. I'll say it a little bit more bluntly. For those of them that are considering investing in their business, investing in PPE, it is best to do it sooner rather than later. We have seen since about October or so, interest rates moving upwards very aggressively, which will mean their borrowing costs will go up. And I think the outlook for the near term, at least, is that borrowing costs will continue to rise. So if you are planning to fund reinvesting in your business using debt, I would encourage you to do it sooner rather than later. Get commitments from investment bankers like myself very early, lock in that pricing. And if you have cash on your balance sheet, I would recommend that you stay short. As Sarah mentioned, she didn't mention repos, but that's an attractive investment for them at this time, given that rates are rising.
Mr. Crawford, I don't know how you did it, but you just flowed into my second question, which means I can ask you to continue. I was going to look at the two eyes, inflation and interest rate, and how it has impacted the economy so far, how it will impact the economy, and what's the forecast that you have for both of them, inflation and both inflation and interest rate. I started Ryan with this one.
This is locally, right?
Locally, no,
Locally.
we're just locally here.
No,
okay?
because we do in.
I know, but
okay.
let's keep it local.
Okay, got it. I think we're gonna see. I think the aggressive action by the Bank of Jamaica may have put a cap on the rate of the inflation increase. And I was one, I suppose, a minority who actually celebrated the move because I thought it was proactive. I thought it came ahead of a global rate increase and any potential of you being able to get a better fixed income rate in the US, for argument's sake, than in Jamaica. So from it was 8%, I think it was November, I think, or it was October, and then November was 7.8 or somewhere in that range. there may be a slowing. Ultimately, time will tell because there are more
And
pressures.
that's in the general marketplace.
Yeah,
It's
well, the
not-
inflation.
They,
Yeah,
they fall, okay.
yeah. So I mean, but time will tell because there are more pressures, or I think there'll be headwinds coming this year. Supply chain. You see oil prices at $91 per barrel now, so will be more. So I do expect an increase in inflation. It may not be as aggressive where we were at 2%, and then we jumped to 8%, in the space of, I'd say, about a year and a half. Interest rates, again, I would expect the BOJ to continue to be proactive, and I think that in turn could find its way impacting on mortgage rates, car loans, just cost of capital on a whole. But I do think, unlike prior times, we're somewhat stretched economically and, household debt, all of that. So there's the element of how much can we accommodate before you start to see defaults, and then where is that point and where it will all end. I'm not exactly sure where that point is, but I am mindful of it because we can't just have rates going up forever. So I don't foresee, for instance, a 20% mortgage rate again. Just to put it like that.
Very good. Richardo?
Yeah, I could just pick up from where Ryan left off just now. I too don't see us going back to the days of double-digit interest rates, because the macroeconomic factors do not justify that, neither here nor in the context of the US in the 1970s or the so-called Volcker era. It's important for us to step back and try to understand what the central bank is attempting to do. We are fairly new young, I should say, in our inflation targeting regime. And it's critical as an inflation targeter that the central bank commands the confidence of the local market, that they have the policy variables under control. And that is why the central bank acted in the way it did to what you call anchor inflation expectations. Now, this is important because you would know that the nature of the inflation that we're seeing now is driven on the supply side, right? Which means supply chain disruptions. Interest rates have nothing to do with that side, quote unquote. What the central bank is attempting to do is to front run the so-called second order effects, right? So once you see those price increases coming in, then people are going to start adjusting their prices. And that is what we call the second order. And that is what the central bank is attempting to do. Now, that is a very data-driven process. So I don't think none of us here, not having the raft of data that the central bank has at their disposal, none of us can really opine on where it will actually land. But based on what we're seeing, the expectation is that inflation is likely to remain elevated in 2022, and consequently, the BOJ will be sensitive to that. So we could possibly see further rate increases, but is it going to be of the magnitude of 100 basis points increase that we saw in the first instance? Chances are no, but the central bank will be sensitive to that. There is also another important element that we have to keep in consideration. There is the so-called neutral rate of interest. And that is the rate of interest at which the central bank's action is not inimical to economic activity. And based on the data that we're seeing out of the central bank, even the increase that we have seen thus far are not likely to impede economic activity, right? So that is our working hypothesis. We think it is still a very important point now to do the fundraising of the nature that Sekou, Ryan, and Sarah indicated just now for small businesses. And for retail investors, it is also an important point to continue to invest in equities, right? Because equities actually will provide a pretty important hedge in your portfolio at this point, given that fixed income yields are fairly low. They are near to what we call the zero lower bound, essentially. And we don't expect that yields will increase significantly going forward. So even in the fixed income space, where yields and interest rates are concerned, asset selectivity would be paramount here, right? So that would be our working hypothesis on those two, interest rates and inflation.
Thank you very much for that elaborate explanation, Richardo. We have online Peter Thompson, who is the group manager for client investment at JMB. He's just joining us. And I want to put the question. I'm not sure if he heard the question at the time, but we're looking at the two I's, interest rate and inflation. How will they impact the economy? How far you see it going? When will it end? How is 2022 with those? Peter?
All right, thanks everybody. So yes, I was online and I did hear the commentary around the two eyes. All right, for us, it's safe to say that we are now in a world in which the low interest rate environment that we've seen globally is coming to an end. The entire financial system globally has been hooked on low interest rate. You know, for us in the industry who have been here for a little while, there have been this period of low interest rate is not the norm, right? So our view is that you should see some increases in interest rates in the near future, and we coupled with some amount of inflation. Now, what this means for both rate setting and policy setting as an investor and also as a company, you now have to look, how are we going to position ourselves in order to capitalize on this new paradigm that we're in? So interest rates in the going forward will make cost of capital a little bit more expensive, and as such, small businesses should be thinking, how can we actually delever our balance sheet and look more towards equity capital? There are a number of good businesses out there with good business models that should be, for some time now, should be looking at moving away from fixed income and getting more equity capital. Investors,
Peter,
on the other hand.
for a minute, Peter, you said the small business should be looking at the balance sheet, and so you're thinking then that interest rate, the hike in interest rate has a good way to go, because I wanted to know, should people be scared that this thing is going to go too high? I think Ryan mentioned that, and I don't see a double-digit situation. Is it time to look at that, or are you expecting a tapering of it and a coming back down, etc.? What should the small business people do?
All right, to that point, so I do agree, right, that you should see interest rates. So the spike in interest rates that the central bank did over the last couple of months is to actually embed the confidence as we move to a more inflation rate targeting. The central bank needs to ensure that the economy, our economic participants are aware that and actually believe that the central bank will be focused on reducing inflation. So the spike, however, I do believe, and this is I think where we disagree, I do believe that inflation will ameliorate over over 2022 as supply disruptions get a little bit normalized. Now, there's a number of factors that could change that. Geopolitical factors could really affect that. But the supply disruptions that we've seen over the last couple of months, we should see some amelioration of that. With that, we should see the central bank lighting up on the use of interest rates as a policy tool to bring down inflation. That said, with all of that said, the last 10 years, the interest rate environment that we've seen over the last 10 years has to stop. Cheap money has been floating around the globe for the last 10 years. Policymakers globally are recognizing that has to stop. With the central bank, with the Federal Reserve looking to increase interest rates globally, or in the States, we should see that knock-on effect right throughout the globe. So my take on it is that interest rates will, there is a position, or my bias is towards the interest rates much higher than what it was in 2018 and 19, right? And as such, the capital that you're utilizing to fund your business, you need to now change the dynamics to more equity type capital. The challenge with waiting so long to do it for small businesses is that if you did not lock in interest rates earlier in your borrowing cycle, you're now going to be paying a higher cost for that. And as such, it will take a little bit more. You need the support of investment bankers to kind of guide us through that. What is that policy, that capital structure that you're going to be utilizing? But what we do know is that interest rates are going to go higher, and the cheapest form of capital is equity capital. And it's not only cheaper, it's more sustainable. We need, as a country, so where small businesses recognize that you need investors in, and it's not necessarily debt financing is the only way to do it. And we're not saying that equity capital is listing on the stock exchange alone. It means going through the route of getting investors in, and then building that robust business model, building a real business, and then looking to invite public into your organization or your capital structure. So I do believe that interest rates will be higher than what they were in the last couple of years.
Well, will they be higher than where they are now? We're referring to
No.
locally.
Locally, interest rates, in our view, there's the spike that you see, you may have another 50 basis points to go. Now, again, we don't have the gamut of information that the central bank has. But when we look at interest rates, what you call interest rates, whether it's short-term interest rates versus long-term interest rates, the central bank is in charge of short-term interest rates. And when you 0 to 1 year type rates are much higher. But if you look at the longer-term rates, the longer-term rates are a test on how the market participants believe in the long-term economic stability and policy direction of the government. And so even though you've seen a spike in short-term rates, we've not seen the commensurate increase in longer-term rates. So it's not a shift in the entire yield curve. What we've seen is a pivot in the yield curve. But as inflation,
which will soon end. It does have
which I believe,
going. Yes.
Which I believe, as inflation ameliorates, you see short-term rates coming down. However,
I just wanted to answer
longer-term rates.
You don't need to elaborate. I want to bring in these comments. And because the two I's have been elaborated on so much for Ms. Cummins and Siku, how does that impact the dollar, the Jamaican dollar? Ms. Cummins, you there? How does the two I's? How will the two I's impact the Jamaican dollar?
The Jamaican dollar. Okay, so well, what I will say is that the central bank definitely wants to manage within this inflationary target and doesn't want the depreciation of the dollar to become a detractor. What I will say is that, in December, and so what the central bank does to manage that is obviously do interventions where they'll come in and sell into the market. Based on the last report I had, they would have done about 50 million sometime in December. We know that, the dollar has seen, volatility in terms of appreciation and depreciation. It can be seasonal based on, obviously what we expect in terms of inflows. So that could be things that affect us from a tourism sector. Likewise, if we think about the pandemic and the impact, what we saw was greater amounts of remittances during this time. And this was as a result of, the kind of benefits that were happening in the US, right? That would have supported remittances here. So I mean, the dollar is something that investors, the market generally will continue to look at. If we think about many of our businesses, and Sekou pointed to this in terms of managing costs, right? The reality is that, the inflation that we see, there's an argument to say that a lot of it is imported inflation. And so with input prices of things going up in the States, right? So again, you're seeing higher, as was pointed out, higher interest rates, the Fed announcing interest rate increases in the States, again, to kind of curb the inflation that they're seeing there. It will naturally translate and it will put pressure on our dollar. So because a lot of the inflation is imported through the cost of input prices, it's going to put pressure on our dollar. So they go hand in hand, but what I will say is, the central bank does have the mechanisms in place to manage, like volatility in our currency. I mean, we have I think net international reserves were at the highest point, record levels at the end of December. So they have that within their arsenal to manage volatility of FX.
Thank you very much. Siku, the dollar.
Yeah, I'll take things from a different angle, Nigel. If you plotted on a graph over the last 5 years, local interest rates and US interest rates, right? They would be very close. And at some points along the yield curve, you'd see Jamaican dollar rates being lower than the US dollar rates. And if you ask yourself as an investor on a risk-adjusted basis, if I had a dollar and I had a dollar to invest in Jamaica and I had a dollar to invest in the US, which one should command the higher rate? Now, just from a risk-adjusted basis, I would want a higher rate on my Jamaican dollar investment than I would on the US. So I agree with my colleagues that the BOJ doesn't set rates that the market has access to. That is market determined, right? At the end of the day, the BOJ uses various tools and mechanisms to influence that rate. But at the end of the day, it will be market determined. Now, if I'm Peter and I manage a large pension fund, regulations aside, if I could do anything I wanted to do. If I, as an investment banker, came and presented 2 opportunities to Peter, he's gonna say to me, "Hey, Sekou, the Jamaican investment, I'm gonna need a differential on it. I'm gonna require a higher rate of return on that investment because of the risk associated with investing in US versus Jamaica, not even bringing into play as yet the expected depreciation annually." So to answer your question, I think, which was, will we continue to have high interest rates? I think.
No, my question for you, I switched it for you to say, how will all of that impact the Jamaican dollar?
Okay, so it will continue to cause the volatility in the dollar, which with the BOJ will, I believe, continue to intervene to make sure that the exchange rate doesn't go out of place.
Thank you. I have less than 10 minutes to wrap this up. And so the question I'm going to ask you, I just want you to answer it direct, without a whole lot of, right? And I'm going to start with Richardo with this one. Which sector you think the money will go to where investment is concerned for 2022? Which sector? Manufacturing, distribution, financial, which sector?
Well, that's a challenging one to answer, Nigel, because no one sector can absorb volume of capital that's available. Yes, but notwithstanding, I would say that the manufacturing and distribution space remains fairly robust, and the continued improvements that we're seeing in the employment numbers should support consumption and therefore should support those companies.
Good. Thanks. Ryan.
This may be an oddball answer, but I believe that media and communications bear the most promise at this time, with information accuracy being at a premium.
Thank you. So cool.
My pick is energy. Given the government's plans, we have a Vision 2030. I think you'll see energy projects going up across the country, IPPs
Renewable
especially.
energies.
Yeah.
Okay. Good. Ms. Cummins.
Hi, I would align with Richardo. I think that there is a lot of capacity in manufacturing and consumer branded products. This will all be supported with the reopening of schools. Our PM has already pronounced that, we're not going into any more lockdowns. So with the easing of restrictions, I think that there's a lot of capacity to see even further resilience and growth in manufacturing and consumer brands. Like Sekou, my expectation is that we'll see more opportunities within the energy space. This could be, retirement and replacement of older generation units that we have. So I expect to see more continued investment in our energy infrastructure.
Thank you very much. Peter?
Well, my take on it is twofold. One, where it should go and where it will go. I believe it will go to manufacturing and distribution because of the recovery story.
Where it should go, short.
And where it should go.
Yes.
Technically, if you look at where the valuations are, believe it or not, finance is undervalued. And I think we should see some capital flowing there. But in terms of what's hot, manufacturing and distribution.
And we're looking locally now. Please, locally. I'm going to ask each of you to name your top 5 stock picks for 2022. And it's the mix of the main and junior market. So the 5 should come from both markets, not 5 from each. Your top 5 picks, and I see Sekou looks like he's ready.
No, well, I was going to say that I think Sarah should go first because you picked her last every time, followed by myself.
She'll go after you, but go ahead.
Okay. So I'll pick JMMB. I can't say NCB because it's a conflict. I'll say Panjam, Wisinko. On the junior market, I will say Lasco.
Which one?
Lasco manufacturing. No, Lasco distribution. And then finally, jumping back to the main, I'll say separate.
Thank you. Ms. Cummins, your top 5.
You're asking me a very loaded question. You know why? Because I had my stock picks, guys, and in all honesty, I did get a call to say, listen, at Scotia, we don't like to name names. So I hope you can read between the veil of what I said, which is that I do believe, names that are in manufacturing of, consumer branded products, distribution of those products. I too agree with Peter. I think that certain financials like a JMMB can see some.
In 2021, you tried saving towards your goals. So in 2022, try investing towards them. Investing in stocks in 2021 has provided our clients the growth needed to achieve their financial goals much faster than a traditional account. NCB Capital Markets makes investing easy with online investment tools and support from our Wealth Hub. With your NCB online access credentials, you can open your investment account online in less than 10 minutes using Go IPO. Go ahead, make the move and make 2022 your best year yet.